We're just talking about how we might see another record in the markets today. And I'm wondering how you look at that, because everybody says the Fed has let financial conditions get too loose, and that is going to lead to inflation again. But financial conditions indexes really measure asset prices. And if asset prices go up, then financial conditions get looser. It's sort of circular. Do you think that you're restrictive at this point?
Oh, I think monetary policy is restrictive. We're in restrictive territory, but no doubt the economy has performed stronger in the first 3 months of the year than we probably had anticipated, than I had anticipated. At the same time, we saw that inflation progress stalled in the first 3 months. We did get a April CPI report, which was welcome news, but I think it's too soon to tell what path inflation's on, so we just need to collect more information on that. But we're seeing moderation on some of the real side of the economy. It's still a strong economy, but we are seeing the impact of the monetary policy that we put in place.
Well, do you reject the idea that financial conditions got loose and that's the reason the first 4 months of the year we saw inflation level out or go up a little bit?
Yeah, the markets are going to be the markets, right? They move up and down. I think the way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced between labor demand and labor supply, and so we're seeing that kind of work its way through. And that rebalancing is going to put downward pressure on inflation, I think, as things play out. It's just that we didn't see that in the first 3 months of the year, and we're just going to need to gather more evidence on what exact path inflation's on in order to sort of determine whether it's on that sustainable downward path to 2% that we're all looking for.